Share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Tonight's video, I'm going to talk about the FOMC minutes and some of the other moves that we're seeing by the government. And all of a sudden, things are becoming very clear. Let's get into tonight's video. Well, welcome everyone. It is Wednesday night, and we had a fairly lackluster day, only to be followed by the NVIDIA news and earnings, which has popped the markets right now about 1.3%. And so once again, we keep bumping up, and the way that the market's trading, I think, is interesting. We fade back in, and then we get a bit of news, and it jumps 1.5%. It's just literally these big jumps, and we keep jumping at this. Each time we make a higher high basis, the S&P just a little bit higher on the pattern. Now I'll show you. I've got the sheets running, already run for tonight, and we're starting to see 60 handle projections. So we're getting closer and closer. We keep edging towards some of the numbers of going into an all-time new high. A couple of things that I've been noticing. I feel sorry for, I follow Bitcoin, have a little bit of action in there, but I feel sorry for Bitcoin folks, because now you get JD Vance showing up and at conferences, and the U.S. government getting involved in Bitcoin. Not good, folks. I'm sorry. Just not good. You thought the market makers and the ETF guys were bad. Now you want U.S. government involved in here, and they're talking about stable coins. Let's face it, the regulation probably will end up just taking over the whole thing. And all of the folks that scream they want a legitimacy in Bitcoin will pay the ultimate price, I'm afraid. Could be wrong, but I don't like what I'm seeing here. I had the opportunity, we'll call it an opportunity, to watch something tonight that I thought, man, it just kind of brought everything back. I remember being optimistic about when Trump got into office, and Doge and Musk and everybody, and we're going to cut all these expenses. We're going to cut trillions of dollars, and of course, it's down to 130, 150 billion, which is still real money. But my point is that in the end, governments are just governments, and the more you see them, the less you like them. At least the way I feel about it. They're just not forthcoming. And I've been complaining about the messaging around the tariffs and everything. It's a mess. And I had higher hopes. And there's something else that happens. I had a heavy passion, fortunately not too heavy, to work for Howard Lutnick back in the day, because I would have been in the towers that morning. I love Cantor Fitzgerald. It was an amazing company. I don't know much about the revival of Cantor, what it's like now, but back in the day when they were coming into prominence, it was a pretty amazing company. But what happens when people get into government? They just change. It's like, they morph into some thing that's, I don't know, not forthright. I want to say not sleazy, but just doesn't feel good. It's like all of a sudden their credibility goes away. So I'm very, very disappointed. Like I said, I had a lot of expectations that I thought were good. Maybe they'll still surprise me. But this is what really triggered me today. And I thought, I want to talk about this today, because all of this budget, the big, beautiful bill and all this stuff, it's all just a gaslight because they're using numbers. They're multiplying by 10. Over the next decade, we're going to do this. Over the next decade, nice way of saying we're not going to change anything. It's pretty much going to be like it has been and will be going forward. So the idea is that somehow that everything was going to get shredded and reorganized and all that was encouraging, and I think that's what a lot of people voted for, and that's not what we're getting, at least at the moment. There's 6 months. So maybe there's a turnaround coming, but right now it looks to me that it's just all smoke and mirrors, and all of the different talking heads and secretaries of whatever have the same line. The good news is markets are starting to come alive and realize that that electric cars are not a thing. People criticized me a year and a half ago, 2 years ago, going, people don't want these things. Now GM is backing off, but yet their statement is, Mary, the CEO, goes, we're going to pull way back, but we still believe the ultimate is an EV world. The ultimate is not an EV world. That is not how it's going to go. We will stick with hydrocarbons for a lot longer. A lot of folks happen to believe in. When I saw all this, and I'll get to a point here in a minute, because it just the optimism for me is fading very quickly, and we're back to markets as usual, but with the exception, the market participants are playing in hand to hand with this stuff, as far as I can see. You're looking, like I said, we're up at 59.86 right now. Up 83 handles, 1.42%. So, it's obviously, like I said yesterday, it's working. I'm not trying to fight the tape. All of my metrics, by the way, I'll show you the data sheets and everything that we've going. If you're reading the Substack newsletter, everything's positive. We still have positive tone. Everything's working. So, I almost feel like I used to be very careful about getting too involved with the noise in a market, that I'm going to kind of pull back a little bit, get heavy toward the quant stuff that I always do, and not get been way too involved, I feel like, with the noise in the markets, which I always tell you folks not to do. And I have been, I feel like I'm guilty of doing that. Just looking at a couple of things. Let's talk about the FOMC minutes. I didn't see anything outstanding in there, anything that really was, going to change anything. All the participants are worried about tariffs. Oh, surprise. And, and inflation. Meanwhile, this is a group of people that claim they're data driven. So if they look at the data, so far there's no evidence for them to be worried or concerned. So I'm not... I'm a data-driven shop as well, and I'm not really concerned. We'll look at what the short-term models are doing. I suspect not a lot happened today. I haven't looked at them yet. I'll go through that next, but I really feel like what we're seeing here is just this clawing back of the markets trying to get back into normalcy, and who's taken over again? The tech stocks. If it weren't for NVIDIA right now, we'd probably be down. It was not necessarily a positive trading day today. It was really more neutral. It was after the RTXL signal, so we should have been a day sideways. We got that. Then here we are. We've got a bid back in the markets again, and it's got nothing to do with the economy. It has everything to do with one stock and a group of stocks again, the tech stocks coming in. So if I get through everything fairly fast tonight, maybe we'll take a cruise through looking at some of the Meg 7s or something like that. We'll take a look at that. So for tonight, then, it's Wednesday. We've got 2 more trading days. We have Thursday and Friday for the month of May, so we're going to close that out. We want to always be aware, like at the end of the month, that on Friday there might be some window dressing coming in. I don't see it being a big deal, but you always want to be aware of that. And tonight I'll touch on the monthly charts when we go through the S&P, just to take a look at how May really played out. and then we won't get a chance because of the way it's closing. I won't, probably until Tuesday of next week, we'll have data on the as far, excuse me, as far as the monthly patterns go, and that I'll need at least one day of actual data on Monday to be able to do the analysis. It's possible we would have something else so that comes in, but I don't expect there will be anything. All right, so let's go ahead and we'll go through the to the database here. Let me just get some things set up, and then I'll bring it up on the screen. Yeah, like I said, not too much to look at. Let's go ahead and take a look here. All right, so we're at 66%. We had pretty much just a rotation. I talk about the markets getting into a rotation here. So if I move this over, we had right here, we had basically 260 buys or new entries, and then we had basically 260 exits here. We're at 66.47 on the bullish percent, still hanging well above that 62% level. And I don't know if we have enough time. If I can swap out some stuff, I might run the statistics for the models as well, just to see if there's anything being picked up. But I think I'm just going to leave that alone. As far as what's going on here is exactly what we're typically going to get on that stuff. Okay, sorry, I'm just checking. Anymore, I get nervous when I get texts. I think everybody's hearing me fine, so everything's good. Okay, so yeah, not much here, and I did not expect much to be available here. So we're really just doing what we're supposed to be doing. Markets just kind of consolidating here. We got up to about 72% bullish. We backed off about 65, 66. Now we're right here at 66, just kind of grinding here. I still think we could see a further pullback towards 58. I don't think we get much below 58. 58 to 52 is the next support levels that we will get to, and that kind of gives the short-term models an opportunity to refresh. As far as we'll just touch on talking coming into Friday's run, which is the intermediate run, we did see a slight increase above that 42% handle, which is telling us that we're starting to get to a point where we're going to have a sustained run, and the markets are going to stay somewhat with a bullish underlying bid, but we don't really have a lot of information ready to go to the next level, and we're going to have to look at the technicals to go to that. So let's go ahead and look at the S&P. So over here, 2 days ago, we got that RTX sell signal, which tells us that we get 1 to 2 days sideways. That one day was today, so we basically had one of the narrowest trading ranges we've had for a while. And then we get the NVIDIA earnings out, and they pop this thing. But I want you to notice something, and I've been talking about this for several days. Even though we're getting these bounce backs, if you look over, if we go back, maybe 2 weeks here, let me just touch on some of these. The high levels are going to, I'm just going to run across some of these high levels. So we had 59.27, 25, and then a couple of days later, we're 59.87. Now here we are again at 59.97. The sheets that I'll show you in a minute on the S&P are suggesting we're going to get into the 60 handle, and there's a trade that it suggested a breakout trade for today. And it's interesting because I know somebody talked about it. Well, when I bring up the sheet, I'll reference it. But a couple of days ago, we had this breakout trade where it's telling you to buy RTX, and our intuition and what I've been doing for a lot of times, I'm usually looking for some kind of contra trend trade against the RTX, which is the market grid's projection of the highest numbers that you can get on any day, right? So that's the extreme prediction for the day. And typically, the last thing you want to do is buy the breakout above that level. But it's interesting. When I was training the algos that builds this data sheet, one of the things I talked about is respecting the momentum that is there. So when you get these big momentum days, and we're there now, you'll see the sheet in a minute where we have like an 85%, I think it's a 7 or 8 trend level. When you get there, I mean, markets are going to run. It's like there's the new phenomenon, I'm going to call it, is the maybe Jim Cramer's trained a bunch of you folks how to trade, is to buy high, sell higher, right? That's why I always call it Jim Cramer trade. So that I've seen out of the sheets in the last week or so, I've seen several Jim Cramer buy high, sell highers, which would be buying breakout over R3 into RTX or higher, and those type of things. So, but this pattern is really, if we look at it, we dipped down, we came to the 21-day moving average, and then we bounced up. But let's focus on, before I go to the next level, let's focus on these areas right here from what's going on with the PPMs. I mentioned that we have into next Wednesday, a week from today, is where the peak value is going to be on this 40 period moving average. But it does appear we're still going to keep losing momentum, and momentum bounced a little bit today. If we look over here on the far right, we'll see it's at 0.12, so we're well below any trend level. If we look down here at the PPM2, it's at 0.32. And in fact, let me just go to the let's go to the sheet and just look at this sheet here, see if we can get zeroed in here. So right now, when I took this snapshot, 59.91 was when it was at 59.84, so it's a little bit lower. This is a little 85. We have an 8 out of 10. PPM3 is neutral, negative, second derivative. So let's look at these green boxes here are what focuses in on the PPMs. So if I just take a little bit of a look here, you see here's the 0.142, 0.33 at the time when I took this snapshot was PPM2, and PPM3 is 0.14. So without going and bringing up the probability chart, I'll just tell you a little bit about here. What it's really telling us is that we're below trend level, we're below the maintenance level. So you notice it has an N by it. So the programming has been that if it's below 0.15, it's neutral. And then if it's above 0.25, it's in trend mode. So you can see here plus T on PPM1s, just so if you have these sheets and you can get that. And by the way, if you go to my Substack, kendallreport.substack.com, there's a full, I think it's a big document. I think originally, in Word, it was like 18 pages, but every aspect of this sheet is discussed and shows you, talks about how to interpret and what these things mean. But when we see these, so we have neutral, we only have one positive PPM2, and a PPM2 is tied to the 21-day moving average, and that suggests that what we're looking at there is really Sorry about this thing sliding around here. What we're looking at is that it's everything's neutral here. It goes through the first derivatives and tells you about that. Sorry, I'm zoomed in and it's doing weird things. So, but as we come down, here's the R3 target 6003, entry 91. So I believe that was triggered, but I think there's a better entry here. I would look for around, we're trading 83 right now. I'm thinking 78 is going to be a better trade if this is going to work. Breakout RTX entry 605 up to 6027. This would be yet probably another 2% day would have to happen to be able to do this. I'm just looking at key insights here. Strong breakout with the big gain. PPM2 solid trend mode. This is everything I just talked to you about. So basically, these sheets are going to reflect my sentiment, since I was the one that actually programmed these. So you're gonna expect to see that type of action. So let's go back to the chart and see if I can. Let's look at. I said I would go to a monthly graph, so let's go ahead and take a look at the monthly. So interesting. A quick review here as we're coming into the end of the month. So if we go all the way back here to 1st of May, actually this is 23. This is interesting, and I know I talked about this before, but we had a fib target up here. 6136 was the target. This, where I have my cursor right now, is April 23. So this was 2 years ago projection. We still have the next projection up at 7142. But the way this formation's coming, this is going to be, I'm glad I brought this up, and I'll go through this probably next Tuesday once we have an update for the next month. But we had this big spike down, which it was way outside of the bounds of what the expectations were. For instance, the STX, the extreme projected for the month of April, was 52.56, and we hit 48.32 on that, on all of the end of the world scenarios that were flowing around the tariffs. And if nothing else you got out of my opening comments today is nothing's changed. The government, we're not going to see these. I don't think we're going to see any shocking changes. I think we're just going to see some shifting of the elements around. But what was looking like maybe a complete renaissance in government and everything is we'll see. Like I said, it's been 6 months, but it's starting to feel like we're just right where we always were. So, but these targets are still valid. So I'm gonna blow this up and just bring this up real quick, because I think this. I know you folks that have been around the channel for a while have seen this illustration before, but I need to bring it out and just draw it in. There's no way around it. So the market grid, which should happen, we might see it still expand out, but we are going to start to see that same formation. And you're going to hear some things I haven't talked about for a few weeks, but I'm just fictitiously drawing in. The markets are going to trade probably within this range. And what we're going to see is that we've got this big volatility explosion, and part of that was going through STX, trading down to 48.32 on the monthly bar, and then what we get is a bubble, and I've talked about this before. It's similar to what happens with Bollinger Bands. Bollinger Bands are based on standard deviations. These are based on actual range volatility. Okay, so they're similar but different. And what happens here is this, as the look back comes, the markets will normalize, and we won't be able to make a decision for next move for multiple months. So we're sitting here right now, into May, coming into June, hard to believe, but coming into June, and probably dog days of summer ahead. We'll see what happens. With the news that's around, then the White House is generating all this. It's funny that I'm going to say it out loud, but almost generating fake news. I keep seeing them claiming that they've got one deal done with the UK. I don't see that deal done. I mean, I see that deal as partial done, nothing signed, and there's so many elements that I don't think they'll ever get it actually signed. So, but they like to claim they have a deal, and they don't. But they have segments of a deal. But what we're seeing here then is we're probably going to have this overhanging of this uncertainty around, and we're going to have to consolidate this. Now, I can't put a cursor on here, but I think we're looking into maybe first quarter of 26 before this normalization happens. So are we just going to run away? We do have the fib targets up here. If I put my cursor up here, we do have that 7,100 fib target. I don't think it's realistic. I'm going to show you something else once I take these drawing tools off. Then I can show you some other data. But this is probably where we're going to be. From an index standpoint, that means we're going to get a large range bound, probably higher than normal volatility for multiple months. Could a new high happen? Sure. I still think a new high gets rejected if it hits anytime in the next 4 to 6 weeks. If we see 2 weeks, right, we could be at a new high tomorrow. Actually, that's a possibility, right? But the once it gets there, I don't think we see follow through unless there's something we don't know about right now, and everything that the Trump administration has told us comes to reality, and we have deal after deal after deal, and the whole world is coming to build all their factories in the United States, which we know is not going to happen. But that certainly will be what the cards that will be played. So, but this pattern I have here is probably a very realistic pattern. We could see, maybe a bar come up here, and maybe the range is a little different, but I think we stay within the market grid. I'll cover this on Tuesday. We'll see what kind of numbers come out of the market grid for the month when we get that update. But I think this is where we end up. So I know folks want to get all excited, and it's time to roll. I mean, there have been summer rallies seasonally. It's usually not that great of a time. So anyway, that's my scenario for right now. If we, I'm going to switch over to SPX real quick, and the reason for that is I have more data, so I can see what the algos are telling us on the monthly real quick. So this is S&P cash now, and we don't have quite the volatility expansion that we had on the futures, but it's there, and so we should see. I think we stay within this. If we look at the red dot projections, it's telling us we're going to stay here, in this, just looking here, 58, 57, 50. We're going to flatten out here. And you can see momentum, and this is monthly momentum, is actually dying off as well. And here, where my cursor is right now, is September of this year, it's not at, it doesn't look like it's going to bottom out until, really first quarter of 26. And I haven't talked about it for a while. But I still have expectations of soft quarters, whether we get to negative GDP in Q3, Q4. I still don't see any big expansion of any sort coming at this time. So, I think we're stuck in a range. I think it's a big range. We obviously established a spike low there, but that will be the parameters between where we end up probably in the month of June if we are able to continue a rally up towards the upper end of this range. Like right now, 61.24 is RXT for this month. So that would be right getting close to an all-time new high. And this is cash again, not the futures. Okay, so I'm sorry to confuse you, but I need the extra data to be able to calculate. And it looks like let's assume for a moment that the algos are right in what we're seeing here. It's telling us we're going to be sideways in a range consolidation, potentially going into third quarter of 26, 27. And that would be my expectation. I think we're going to have to be looking at being really good stock pickers between now and then. I think the indexes are going to be somewhat confined to the type of activity we're going to get, just because we basically blow it up. And I've talked to you about this before. Once you blow up the ranges like this and you get that volatility, you've got to normalize. And it does it every time, not sometimes, every time. It's just how long does the normalization take? I would argue that we had that back in 22, and we came all the way into September, October. This was in this range here. This is probably one of the cleanest buys. If you're around the channel, I was screaming we were getting all kinds of traction on the database, and that we were going to have back-to-back 23 and 24 were going to be double-digit return years, and we indeed got that. We are still, in my opinion, let me blow this out, just to make, if we look at going back to the to that 22 low coming in here, what we're doing right now is this big giant move 23, 24. We are consolidating that move. Once again, this is cash markets we have up here, but we've got a lot of work to do just to consolidate these gains, and then everything get normalized again. And even here, if I could go out, I will go out real quick. But just go out. I'll review this again on Tuesday. Kind of got here into long-term mode, but this is the quarterly charts. And let me just look at the. So we're also seeing this, and I've been talking about it every time I've done the quarterly review in the last several months, is that we were going to come into right here at the end of Q2 as we get into, we're second month into Q2. So we got one more month, but as we get at the end of June and we start to look at the next phase, we're going to see more consolidation, more really trading opportunities in individual stocks, but not these indexes are not in a runaway mode. We do have similar. We have 61.18 was a. Let me blow this up here. 61.18. There's right here where my cursor is. 61.18 was fib target 1. Then we have on a quarterly, we have longer term 71, and then we've got a 77 handle projection. But this almost reminds me of when we look at the at the gold chart is we've got this big slope. So the trends are still going to be up, but we're going to probably go sideways into this 10-quarter moving average. So more on this on Tuesday. So originally, just real quick, let me come back up for 1 minute. Originally, when I was talking about if we came into the beginning of the year, first quarter, I was talking about this this big transition in government, which I'm just telling you, I'm discouraged. Maybe I'm being impatient here, but I'm not seeing the things that the action that I was expecting here. So what I'm trying to say here is we're going to see the really large consolidation phase. Doesn't mean we can't make incremental highs, but it's going to be more, sideways with the upward bias than the runaway. Because if we look, if I bring up this chart real quick that I was just talking about, is we look at the base here in 2011. We had this big move, then we got the volatility. Of course, 2020 came into play, and then we've got this big volatility. I still, like I said, each one of these red dots here on the page is 1 quarter, 3 months. So we're looking at, like a whole year, and the whole year says we're just going into this sideways pattern, and those numbers are coming in at 55, 5,800, right where we are now. So I think we've got a somewhat of a tough road ahead, whether it's tariffs, trade wars. What do we have going ahead of us? Putin certainly isn't looking like he wants to stop the war right now. It's kind of an interesting chess match going on the planet right now. And meanwhile, Europe's gearing up and trying to build a military, which is interesting. Probably a good thing for them. But so there's a lot of different shifts going on the planets from a macro standpoint. But this thing is just telling us we're going to stay. We're not going to collapse. There's no crazy crash scenarios around that I see. I know a lot of folks want to present that, and I talked about I won't cover the treasuries tonight because we went through that in detail last night. But there's doesn't appear to be any bond crisis around. And I saw an interesting stat today. It's interesting. I hadn't thought about this actually until today. And about 70% of our U.S. debt that everybody is screaming about, it's the end of the world, 70% of that is that interest is going back into the economy. U.S. interest owns 70% of that. The foreigners own about 30%. It might be a touch more, maybe 32. But the point is that 70% of all that income is coming back into the economy. People rolling bonds over, doing all that stuff. So it's not the net draw as you would like to think. And I've said this for many years, is that if you were to look at the United States at government as a company, you looked at all the assets and all that, look at national parks, land in general, every asset, look at the U.S. household wealth and all of that, the debt ratio is almost zero. If it were a stock, you'd be buying it all day long. So I know a lot of folks like to play out the end of the world scenario and the dollar's going to collapse and all that stuff. Don't spend your time doing that. If you want to entertain yourself, read Zero Hedge and read the stories about the fantasy stories of what could happen if this happens and that happens and all of those scenarios, and enjoy it there. But I would not try to play this out in your strategies at right now. Not the case. Not Ray Dalio's 100-year debt cycle, all that stuff. It is noise. Most of you folks are younger traders. I remember when I was in my 30s and trading, and in 1980, by the way, the big story on the street was the government was going to need so much money that it was going to choke off business completely, and interest rates were 25%. And guess what? It's 2025, we're still here. And, so all of the scenarios, all those things get played out. They make great clickbait. And back in the day, in the 80s, we didn't have but the newspapers and some newsletters and those kind of people, the Jim Dines and different people that were around playing the doomsday scenarios. But now we have Twitter, and we have YouTube, and we have everything we have, and we have everybody that's traded for 3 years that is now a expert because they made some money. Now they're an expert, is out in the world, right? So, I just want to caution, just be careful about the doomsayer stuff. And, like I said, if anybody believed the stuff that they put out there, the doomsayer stuff, they wouldn't be on YouTube. They'd be in their bunker, okay? The fact that they're on YouTube tells you they don't believe a bit of it. Or if they're on Ray Dalio doing his Bloomberg round trip and all that, they don't believe this stuff, folks. So you shouldn't either. Okay, let's move on. Let's go ahead and let's go to NASDAQ. I got into a deep dive there. That's okay. Let's come back down to earth. I should be able to roll through this. I thought we were maybe have some. I didn't know I was gonna. These aren't scripted shows, so sometimes things trigger and we just go where we go. So NASDAQ, same scenario, losing momentum on the daily, even though we keep popping up. Actually, we made a new high here on this pattern. Still an upward bias. I didn't run the sheets here, but I'm sure we're going to have still a bullish scenario from the standpoint of what's going on. Looks like there's some good comments tonight. So when I get done here in a minute, I'll go back and review those things. But anyway, NASDAQ's going to be stronger. Why? Because of the tech stocks. One of the things I didn't get into it. Maybe in tonight's Substack, that might be a good place. I'll go a little bit into some of the tech stocks. I have portfolios that I have built on our portfolio management process with Mag 7, and we can look at some stuff. Maybe that's what I'll do. I'll see if I can throw in some technical stuff, maybe cover NVIDIA at least, since that's the star of the show at the moment. But everything's about the same as it was there. Let's go ahead and I'm not going to cover the treasuries. Let's go to gold. I'm going to go to a weekly gold chart because I'm pretty sure that this pattern So I'm pretty sure we are looking at this at the S&P chart. This is what I was talking about. It kind of reminds me of what gold looks like. Gold continues to have this upward slope. This is a weekly chart. But I still think what we're doing here, I want to blow this up just a little bit more so we can see this. This is what we're attempting. I talked about this the other night. We're attempting to normalize this, and what we're getting is massive volatility. And typically, when we see volatility like this, there's some sort of shift trying to happen. We still have such strong underlying trends here that's not likely to happen. So we should see some kind of a normalization where we start to see the market grid come down into a formation. If you can see where my cursor is right here, typical where we get a blow up in volatility and then it normalizes. So we're trying to normalize, but we've got these huge weeks that keep popping in here. All right. We got 15 minutes. Let me. Yeah, you can see here also the algos are starting to lose some momentum. Just means we're consolidating. It's not, this isn't negative. We're at a 0.80 on these PPMs. Even if I go to the lowest point, I pointed this out before, even these bottom troughs that are being projected here are still positive range. Yeah, I see somebody asking about comment on nuclear energy on 5 years out. I think that's a great theme. I will do some work on that and come back because I have some pretty good ideas. I just don't have them. I need to spend a few minutes just so I can articulate what those things are. But yeah, so let's go ahead. Let's go to Bitcoin because I kind of started here tonight where there's a few things I want to say here. This is weekly Bitcoin. I keep telling everybody that we've got a couple more weeks of this elevated momentum that's there to play this out. I think it's interesting. I'm going to pop over to a daily chart. Okay, it looks like we started a new bar yesterday, which would be today earlier. We were down 1,100 points, and this is after JD Vance shows up at the big Bitcoin conference to tell everybody, hey, U.S. is going to be part of Bitcoin, and they want to have stable coins and all this stuff. Maybe I'm just being a little paranoid here, but I keep thinking about China and social scores and what could be done if they had digital currency. Might not be as fun and as exciting. We basically have that now, right? But the controls switches aren't there. That's my only concern is the government getting more and more involved with these things. And like I've argued before, Bitcoin was, supposed to be outside the system, and everybody that got involved in it wants to pull it into the system. They want it to be legitimate. What a mistake. We'll see. History will tell, but this, I think it was good when Bitcoin was Bitcoin and it wasn't options and ETFs and all that. It's unfortunate in my viewpoint. So I guess time will tell whether this is a good thing or not. We're starting to get, this is the second day, I brought this up yesterday. There's three numbers or two instances of things that are occurring here that I think are important to pay attention to. Is on Bitcoin, we have some new fib targets on the downside, 97,800, 92,007, we'll call it 500 to make it easy, and 89,134. And in the middle here, we have 93,800. This is the green dots here. Let me zero in so you can see this. See these elongated dots that are coming across right here. Those are pivots that are being generated by through the Fibonacci targeting. When it ever elongates like that, that is going to be even the ultimate place to buy. If it penetrates, then it's a big pivot point. Typically, there'll be points where we'll see market stall at or bottom at, those type of things. So that would be the big thing that's here. But it's interesting because the dailies are suggesting sideways to downward chop. If we come back up, that's what the algos are telling us. We'll see what plays out here, but we still have about 3 weeks, maybe as much as a month, of that elevated intermediate momentum to get this through. And I'm not happy that it got up to what, 111,800 and basically reversed out of here. Still got to throw these numbers at you every night, folks. 105 and 100, 105,000, 100,000, and then these fib targets on the downside. If these targets persist, which it looks like they will, we would have to trade and make a new high in this pattern to negate them. So, but I don't think inviting the U.S. government, ultimately, once they have it, then they're going to go, well, now we got to regulate it. It's going to get messed up, folks. I hate to say it. I really do. Okay. So let me come back up here. Let's take a look at and see what kind of comments. Looks like there's hopefully some good stuff. I see. Yeah, I have some stuff out. I see EK is talking about using KGAR analysis. I've got some stuff coming out with our portfolio management that is going to put some probabilities and some real math on portfolios. Just looking around here. See what kind of comments you folks are making here. Yeah, I mean, EKS, I'm glad you're here. Looks like you're a successful portfolio guy. Good luck with that. Yeah, so just to kind of talk about that. So our typical hold for 18, 36 months. If you can see that far in the future, good for you. Yeah, man, you guys, I've got to get this new revision of Wave Tech out there. You guys are just making up stuff on the portfolio stuff, and man, yeah, I've run $275 billion, and those are, yeah. Thanks for the super chat there. Appreciate it. Yeah, just looking at some comments here. Okay, folks, I was hoping you guys were. Yeah, I think the courts will ultimately lose. If we let these circuit courts block any administration, what they're trying to do, then there's no reason to even have a president. We'll just let the courts run everything. I hope that stuff gets squared away soon. That's kind of scary. So if you've ever been involved in any litigation or anything and see how the courts actually work, those aren't the guys you want doing anything, for sure. All right. Okay. So let's close it down. Let's have a bit of a chat. Like I said, I think that the Bitcoin situation is getting scary from my viewpoint. I worry that it's going to be drastically compromised by the governments getting involved and all the stable coins and all that. I mean, why, you know, just doesn't feel, it'd be like having the IRS in your office every day. That wouldn't be good either, right? You just don't want these folks involved in the markets. The less that they have to say with things, the freer the markets, the better they are. And I sense that there's something evil coming there. I could be wrong. As far as just a real quick comment, you know, the on everything that we're dealing with right now, I've certainly expressed, I know a couple of nights ago, I'm still apologizing. I went off on a very long discussion on my Substack about the frustration I'm having with the administration and how they're handling messaging and everything. Right now, you got a lot of pretty people running around on TV sets. I don't know what they're actually doing, but what they're saying, I am just not impressed. I'm very disappointed in a lot of what's going on. Hopefully it'll all wash out here. We're probably going to have to give it a full year. Will they get the tax bill through? If they do, that's a good thing, I believe. You don't want them to fail in that, because that'll be the largest tax increase, and then we'll probably start to get signs of that would be a crash, I think, to say the least. One of my big things that I've always talked about is taxation is one of the biggest influencers in markets we've ever seen. You have to understand, I grew up when the whole Ronald Reagan tax revolt happened, and it was a good thing. And in fact, could argue that we're still within that 1980 bull market. You know, we've had, if you look at the long-term charts, there's wave counts that start back in the 79, 80 level at those lows that are still intact to this day on a grand super cycle level. So you could argue that that bull market's been around for 45 years in some ways. Not that it hasn't had corrections, but when you zoom way out, maybe we'll do that on Tuesday night if we can get to that level. But anyway, folks, I think I'm just going to call it quit here. We got one more day for the markets, which will set up the final day in trading of the month. So just be aware that we could see some window dressing coming in. While the markets are positive, I still feel like we keep bumping up on this ceiling and we keep getting rejections off of here. So just be cautious. Everything looks bullish. You can see all the metrics. If you don't have the Substack, get it, kendallreport.substack.com. And for $8 a month, you can get it. There's a 7-day free trial. I actually do need to announce I put the, what is this? I think until probably out for about May 15th, but you can get an annual subscription again for $80. So if you want to grab that, you can, and you can sign up for a year for $80, which is $6.50. So I'm going to keep that. I was going to do it as a Labor Day special, just didn't put it out there, but that's what we'll call it. And for the next couple of weeks, you'll be able to score on that, and that's a good deal for a year. And you get, 8 trade recommendations every day on S&P, NASDAQ, gold, and Bitcoin. And so don't miss out on that. And soon, I'm telling you, I know I haven't talked about it much, but the data sheets are still being worked on. I made some improvements on some things that I think I'm closer. We're still working on the framework to be able to deliver the sheets so you can put them on any symbol you want. Have a good day trading tomorrow, and I will talk to you tomorrow night, same time. Have a great evening.